Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. This week's topic, guys, is trading random? Okay, is there any edge in trading? I've been getting a few emails here and there. I've been seeing some other YouTube videos, some high frequency trading people saying that trading is just random. There is no real edge in trading technical charts. It's just a bunch of basic luck, so to speak. In so many words, that's basically what they said. So today's topic is going to be on, is trading just luck? The people that make money in trading, are they just lucky? Well, we're going to talk about it. And on top of that, we're also going to go into some patterns today, looking at not only 3-bar plays, but double bottom retests, buy setups, etc. and so forth, to kind of look at what is random versus what isn't random as well. So we tie it all together, all right? So again, it's a very fascinating topic, guys. I will use a few gambling analogies in there as well. But the one main thing that we can talk about today is consistency with regard to, is trading gambling, okay? It's a more traditional lecture style video, which I haven't done in a couple weeks, but I think that you guys still like those. It's a little bit longer. It's probably just over an hour. So I hope that you guys appreciate that as well. But again, is trading gambling? Is there an edge in technical charts? I say absolutely there's an edge in it. How is it that the same people continue to make money over and over and over? All right, but we'll talk about it here. It's about a 20 or 30 slide lecture. I hope you guys enjoy it. Guys, as always, if you like the video, please click that like button. We'd really appreciate it. If you like the channel, please subscribe to the channel. But most importantly, do not forget to click those little notifications, that little bell there, the notification bell. It's really, really, really important you click that, and then you'll get notified every time these videos drop. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is day trading truly random with no edge? Is there really an edge to day trading? You get a lot of comments out there from folks, you know, all the people that know everything, you know, the ones that say day trading is gambling and all that, and they say there's no real edge to technical analysis. You know, that's why a lot of firms and hedge funds and stuff use technicals as part of their fundamental analysis. But hey, there's no edge to technical analysis trading. This is a common thing that I have seen a lot, you know, and I could not disagree with those folks more. There is absolutely an edge to technical analysis trading. The question becomes, how much is the edge, right? Is it 1%? Is it 20%? Is it 30%? And how big of an edge do we have to have for it to be meaningful? Okay, so we're going to talk about that today. And we're also going to get into some charts, okay? So this is a well-balanced lecture in that we have a lot of charts, we have a lot of text slides, it's a little bit of both. It's about 25 or 30 slides, and it's probably going to take me an hour to get through it. It's a bit of a longer lecture. But before we do any of that, we have to first talk about, when will the insanity stop? Okay, when will the insanity stop? This week, we have another good one for you guys, brought to you by me here at Live Traders, and this week's special edition is, boom. You just look at these in wonderment and amazement. It's like Talladega Nights. You're so precocious and full of wonderment. These folks that do the stupidest shit that you have ever seen in your entire life, and they don't learn from it. I'm down $110,000 on my short. I just got the margin call. We'll cover tomorrow at whatever the opening price is. I presume it's going to be 860, which means I'll lose $150,000. Any other shorts forced to cover tomorrow? What is this, like misery loves company? And sure enough, you put a little bait out there on the end of the hook, and boom, I feel your pain as well. I've been short for a while and doubled my short bet, which I'm feeling a lot of pain right now. I agree the valuation is insane by any metric. Guys, we're talking about Tesla here, not GME. This is Tesla. If you are caught short on Tesla, you are in deep, deep, deep doggy doo-doo, okay? Do I agree that it's overvalued? Absolutely. It's got a 1,700 to 1 price to earnings. They make 500,000 cars a year. They barely make any money without tax credits. Sure, it's overvalued. That doesn't mean you should trade without a stop loss. I mean, are you kidding me? Like, some of this stuff is just outrageous. So as you can see on the left-hand side, the markets can stay irrational longer than you can stay solvent. All right? And you need to take this one to heart. Why? Because if you don't, you're going to be down 110K or possibly 150K, and you're not going to be a trader anymore. And I say this every week, but I'm going to say it again. You really, really want to know why the general public has such a disdain for traders? You really want to know why all the people on TV and everyone they call the smart money says those people are just a bunch of gamblers? Because of shit like this. And this stuff, as you guys have seen, happens every single week because I put them in my lectures every single week. And honestly, I could put 5 of these in here per week. You don't want to be featured on an episode of When Will the Insanity Stop? Okay, it's not an honor to be on here. Okay, it's kind of like the wall of shame, so to speak. All right, just be smart, guys. Use stop losses, man. Take your damn stop losses. All right, take your stop losses. Okay, all right. So one other quick comment. I figured, well, we always talk about when will the insanity stop. Why don't we talk about something good before we get into the lecture real quick? And this week features Legend. That's my nickname for him. The man, the myth, the legend, Mr. Anmol Singh. How about this kid? 28 years old. $65,000 in the month of January. And you guys saw his P&L today. What is he up? 21,000 unrealized with 9,000 realized? Hello. 21,000 open P&L for the month of February. We're 3 days into it. Okay. And 9,000 closed today. All right. So this is Anmol's account statement, Interactive Brokers account statement from January 2021. $65,265. 28 years old. Okay. That's impressive, guys. All right. That's impressive. My point by saying this is, it's like, what's that saying they have? 10 years to overnight success. Anmol's been doing this 10 years. He's been doing this a long time. He's put the time and he's put the effort into it. Yeah, exactly, Alex. 28 and a half. Anyway, so that's an impressive month. And he's actually off to a way better start in February. After he closes out GWPH, he'll be up about 30 grand in 3 days in February. Okay. So pretty impressive. All right. Pretty impressive is what I'll say there. All right. So let's dig in. But before I quickly dig in, guys, I'm going to pull this just real briefly down. I'm going to raise my stop on ABBV right here to this area right there. So I raised my stop. Now it's time to get back to the lecture. All right. Let me see if that works. Good. Is day trading random with no edge? So like I said, we're going to talk about charts today, but we're also going to take a look at some statistics, so to speak. Okay. A lot of people think it's random. And guess what? A lot of traders are random traders, right? I mean, I think you guys can admit that a lot of the things that you do are random. And a lot of traders that come into this business are straight up gamblers. The question is why? Well, it preys so much on your emotions. And when you are a straight gambler with no edge or no routine or no pattern, no plan, you are a gambler. And ultimately what that means is you will lose your money, whether it's 1 month in, 1 year in, or 2 years in. And this is one of the reasons, guys, I put out some of those When Will the Insanity Stop episodes so you can see what most traders are up to. But the comment I'm making is, you guys once in a while will send me emails about, well, geez, Jared, last week's When Will the Insanity Stop, somebody went from 50,000 to 2 million and then back to 50,000. How do they do that? You're asking the wrong question. The question is, how did they turn 50,000 into 2 million in the first place? By gambling. And their luck simply ran out, okay? Because it was luck. Because they had no strategy or no plan. So when you see somebody out there, who wants to teach you trading, or all of a sudden they've magically overnight become an expert because they took 2 grand into 50 grand and now they think their shit doesn't stink, that's a gambler, okay? That's not somebody who is going to be in this business long term. That's a lot of the Wall Street Bets people. That's a lot of the people on Reddit. That's a lot of the GME people, okay? They come in and they're basically just throwing shit at the wall and hoping it sticks. And guess what? It works sometimes. You can flip a coin and get tails 5 times in a row. But the more you flip it, guess what happens? Reversion to the mean. Your luck runs out. Your luck runs out, okay? So, let's talk about this for a minute. Does anybody know, without Googling it, and I'll tell you in a minute, does anybody know without Googling what the house edge in blackjack is? Type it in if you know. Don't Google it, just if you know what the basic house edge is in blackjack at a large casino. Okay? Does anybody know? Come on, ABBV, rip, baby. All right, some of you are close. Here's the answer to the question. 2%. Now, there's various ways to get to 2%. The house edge is the name given to the percentage a casino will win over the long term in a particular game. In blackjack, the house edge over an inexperienced player, and that's key because let's be honest, the vast majority of people going to Las Vegas are inexperienced players. The vast majority of people in trading are inexperienced players, okay? One quick comment, guys. Raising my stop to break even on GME. Why? Because that's the trading plan. All right. So, back to the lecture. So, the vast majority of people, did I say GME? I meant to say ABBV, okay? The vast majority of people that go to Vegas are inexperienced. So the question is, can this be improved upon? And the other comment I'm going to make before we move along is, do casinos generally as a rule lose money? No, they make money. Quote, the house always wins. You've heard that phrase, the house always wins. And yet their edge in blackjack is around 2%. Wow. Think about what I just said. Their edge is only 2%, and yet they rake in billions of dollars. Now, let's take this a step further, okay? Promise, there's a method to this madness, okay? A player who learns basic strategy can narrow the house edge to less than 1%, about 0.62% in a 6-deck game in which the dealer hits soft 17, pays 3-2 on blackjacks, and can double down on any first 2 cards and split aces only once, but pairs up to 3 hands, okay? That's just statistics, all right? Some other people say the house edge is around 0.5%, but we're close. 0.5% to 0.62%, pretty close, okay? Now again, this can go up or down based on your skill levels. Most players are bad enough at blackjack basic strategy to give up another 1.5 or so the house making this edge 2%, which is what we just talked about, okay? And this is the best game in the casino. Other than video poker, apparently, which is a little bit lower, blackjack is the best game in the casino with regard to the odds for the player, not the house. Okay? But here it goes on to say, most players won't take the time or make the effort to get the house edge that low. Guys, does that sound like anything you've heard before? Most players won't take the time or make the effort to get the house edge that low. To me, that sounds like just about every damn trader I've met. You won't take the time or make the effort to get your edge in trading above negative expectancy. Most traders are trading with a negative expectancy because they're doing all kinds of random stuff. All kinds of random stuff, okay? So when you think about the difference between blackjack and trading, some people go, oh, well, that's a good analogy there because blackjack is gambling. Well, to some extent it's gambling unless you have an edge. Well, some people count cards, right? Some people have a strategy or a system. Now, all of a sudden, what happens? Hold on, we'll go one step further. Now, if you can learn to count cards or master some other advantage gambling technique, you can get the edge over the house. I put this in pink. In fact, if you use a simple count like high-low system and range your bets between 1 and, you'll have a 1% edge over the house. Now you think, 1% is garbage. Guys, casinos only have a 2% edge, and they make billions of dollars because They do it over millions of hands of blackjack over the course of a year, right? You guys don't want to learn trading to a high enough level to gain an edge over the market. That's a fact. It's a fact, and it's why most of you lose. What's another part of being a good blackjack player? Not just knowing the game, but knowing when to double down, which is also money management, right? Knowing when to split your cards. That's not just the edge, it's also money management. Most of you have the crappiest money management there is. You throw a bunch of money at this business. You think you call yourself a trader when you're really not a trader. You're just a gambler because you haven't learned the business well enough. And what it ultimately comes down to is one thing, and that one thing is consistency, right? So if you're counting cards and you get 2 10s and don't split them, what are you doing? You're decreasing your odds, hence giving up your edge. If you found a perfect 3-bar play and take it, but then you poorly manage it or use inconsistent risk, what are you doing? Decreasing your odds, i.e. giving up your edge. But yet, you guys do this all the time, as in probably every single day, right? Getting out of a trade too soon. Sometimes, for example, we can use to, get 2 10s and don't split them. Well, what if you see a perfect 3-bar play and you don't take it because you're scared? You're messing with your edge. Then you take the 3-bar play and you dump half your shares before your trading plan says you should. Now you're messing with your edge. You're constantly messing with your edge. So yes, I agree. The average trader has no edge in the market. They're just a gambler. Most of you listening are just gamblers, okay? Most traders lose because they lack a plan. And in lacking a plan, they lack consistency. And because they lack consistency, they don't have an edge. They don't have, okay, a positive expectancy. So their results are indeed random, okay? Which is why we see so many traders blow up their account or take 2K into $1 million and then give it all back because it's pure randomness. Okay, so you guys are telling me you shouldn't split 2 10s. Perhaps that's true. I'm not a blackjack expert. The point simply here is you decrease your odds when you break the rules. Is that true or false? When you have a system and you break the rules, are you decreasing your odds of success? Yes. Those rules are put in place to give you an edge over hundreds, thousands, tens of thousands of hands of blackjack. Your rules in trading are put in place to give you an edge over the long run. Anybody can flip 3 heads in a row, but you're not going to flip 3,000 heads in a row. See what I'm saying? Stop giving up your edge. Because when you do, you become random. And when you become random, 2K into 1 million is possible, and 1 million to 0 is possible. Well, that's not trading, that's gambling, okay? And you don't want to be a gambler. So let's talk about it. Let's take trading, for example. How often do you need to be right to make money? In trading, how often do you really need to be right to make money? Well, the answer obviously is, it depends. Depends on what? Well, it depends on when you win, how much do you win? When you lose, how much do you lose? So how much do you win when you win? Versus when you lose. 2 to 1, 3 to 1, 4 to 1, 10 to 1. So, for example, a 2 to 1 reward to risk, what's the break-even point? It's 33%. So, if when you trade, you get 2 to 1 reward to risk on your winners, and you lose 1 to 1 on your losers. So, if you risk $10 on your winners, and that means when you win $20, and when you lose 10. That's a 2 to 1 reward to risk. Well, to break even, because a lot of us don't have trade fees anymore, right? Most people, again, there are places that still have trade fees. You only need to win 33% of the time. That's not a very high number. Well, I use 3 to 1 here because Unwall uses it quite frequently, right? 3 to 1 reward to risk is what he uses all the time. What's your break-even point? 25%. You only need to win 1 out of every 4 trades that you take to break even. And yet, somehow, The vast majority of traders out there are losing money when in reality, if they use a 3-to-1 reward risk, they only have to win 1 out of 4 times to break even. How are they losing so much money? Because they're extremely inconsistent. One trade they do 2-to-1, one trade they do 1-to-1, the next trade they do 3-to-1, one trade they have $100 risk, the next trade they have $300 risk. One time they see a perfect pattern, then they don't take it. The next time they see a mediocre pattern, they take it anyway. They are all over the map. You just lack an unbelievable amount of consistency. And you got to ask yourself, why? Discipline, emotions. And what does that come down to? Not understanding oneself properly. Not understanding what you're good at and what you're not good at. Most traders never, ever get to that point. I'll repeat that part. Most traders never get to the point of true understanding, self-understanding, self-awareness. They sit there and they go, no, I'll be better tomorrow. Oh, I studied this weekend. I won't make that mistake on Monday. We just saw it yesterday, or was it today? Somebody was saying, I studied all weekend. And I said, I'm not going to trade in the first 5 minutes a day. And then they literally put into the chat log, Jared, I told myself all weekend I wasn't going to trade in the first 5 minutes. And 3 minutes into the day, I took a trade. Huh? You're messing with your odds. You're messing with your odds. You're not being consistent. This is why most traders fail. Patterns have an edge. Money management has an edge. Trade management has an edge. And it doesn't even need to be that big of an edge. But you guys are so random, you throw the edge out the window. Because everything you do, the only thing you're consistent at is your inconsistency. And most of that goes back to what I said about simply not understanding yourself. Understand what you're good at and what you're not good at. As an example, okay, and I don't know if this is a good example or not. Spud Webb, and a lot of young people are like, I don't even know who that is. Spud Webb is never going to be an NBA center. It's just not going to happen. But does that mean he can't play in the NBA? Nope. He made a career out of it. So it's possible at 5'6" to make a career in the NBA. Why? Because people have done it. But he's never going to be a center. Get my point? Shaq, at 7 foot, 350, whatever he was, is never going to be a point guard. People will just walk right past him. But it doesn't mean he can't play in the NBA. Shaq can be a center. See where I'm going with this analogy is that there are different positions in different sports, which means it's open. It's available to a lot of different people. A lot of people would look at a guy, for example, if you play golf like Corey Pavin. He doesn't hit the ball more than 250, 260 yards, and you think there's no way. He won the U.S. Open. How? He doesn't hit the ball far. And in today's game, granted, he's older now, but 20, 30 years ago, today's game, it's all about power, isn't it? How did he make a way for himself? Be good with your short game. Be good chipping and putting. So if you're not really good at holding for 3-to-1 targets or 4-to-1 targets, maybe then you need to be a better stock picker. Be more accurate with your decisions. So somebody who's got a 4-to-1 reward to risk might be less accurate than you. But you can both end up at the same place in a different way. But you don't understand yourself well enough to know that. And therefore, you won't be successful because you're messing with the odds and you're inconsistent because you don't truly understand yourself. All right? So here's an example. Hey, 3-bar plays just don't work. They just don't work. They suck. And I'll show you, Jared. I'll prove it to you. Oh my gosh, look, there's a 3-bar play on Microsoft. Look at that. Wide bar, narrow bar, entry. Oh, and there's a 3-bar play stopping out on Microsoft. See, I told you, Jared, 3-bar plays don't work. You're just some charlatan out there stealing people's money because you want to sell them courses. I don't really give a shit if you buy my course. All right? The McLaren is in the garage isn't because of courses I sell. I can tell you that. But 3-bar plays don't work. And exactly. Then you go back and look at it and go, well, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 bars up. But then you're going to send me an email and tell me how bad 3-bar plays are because they don't work. But you didn't take a good one, right? Now, This isn't to say good trades don't work. Good trades fail too. But this is where your edge is, in taking good trades and managing them per your plan and being consistent. Okay? We can find good trades like NVIDIA. Okay? Decent gap up, wide bar, narrow bar. So far, it looks pretty good. That's relatively in the upper 50%. Maybe it's a little bit lower than that, maybe, but all in all, decent. That failed. So all of a sudden, I can cherry pick losers. Just, somebody like, oh, you just cherry pick the winners. I can cherry pick losers too, right? So here's a wide bar with a narrow bar that popped up and just stopped right out, came back up and pulled back again. 3-bar plays just don't work. So if you counted cards and your first 4 hands of blackjack you lost, are you going to say the system doesn't work? No. Haven't taken enough trades. You haven't played enough hands yet. All right? So the question, though, is while you're playing these hands, while you're taking these 3-bar plays, are you being consistent? Or are you messing with the odds? And see, here's the problem. Sometimes you guys save yourself money. You win the battle, but you lose the war. So my point is, let's say you took NVIDIA here, 3-bar play, right? Let's say you took it. And let's say you got out early and only lost a couple pennies on this. Everyone else got hammered and they lost $2, right? It went from 538 down to 536 and they lost. I know because I took this trade and I lost on it, okay? But what if you only lost like 20 cents on it? You still messed with your odds. That was the wrong thing to do. It's like making a mistake in blackjack and winning for the mistake. Long term, that's going to cost you significant amounts of money long term. Just because you won the battle doesn't mean you're going to win the war. So you can win the wrong way and you can lose the wrong way too. Okay? Keep moving on. Got a lot of slides to get through. So here's another example. HZNP from yesterday. Wide range bar on Monday. Big gap up, like 8 or 9% gap up. On Tuesday, it's gapping over these 2 pivots. Awesome, right? Cool. The previous day was a massive bar. And you go, wow. Wide range bar, narrow range bar. Rip, entry here, stop here. I'm a winner. Hey, Jared, check out my HZNP trade. I'm awesome. I'm the best. And then you ask yourself, well, what's the 60 look like? What's the daily look like? And this is one of the reasons that traders are going to struggle long term. See, anybody that's traded for the last 5, hell, even 10 years, but specifically the last 5 years, you don't know anything but that stocks that are extended go higher. That's all you know. Every other day, the market puts in a new high. It does. Every other day, the market puts in an all-time high. So you think a stock up 7 days in a row is not a big deal. Well, traditionally, it's a huge deal, and it's probably going to pull back. In fact, it should have already pulled back. But not now. Stock that is up 7 days in a row goes up 8 days, 9 days, 10 days. Okay? And that's how you learn. You learn in that environment. So you look over here, you go 1, 2, 3, 4, 5, 6, 7 bars up on the 60. That's from 70 all the way up to $84. Huh. But you took the 1 minute and you won and you're all happy and you're telling everybody how great you are. Well, that's not a long-term way to win. You're winning the wrong way. I agree with you on the 1 minute. This looks like a great 3-bar play. But big picture, it's not something you should make a habit of trading, and that is key. Do not make a habit of trading this. But on the short run, you got away with it. Again, we go to consistency. Okay? Here's another example. This is Tesla yesterday. Tesla, good 15-minute 3-bar play. Well, wide range bar took out the prior pivot, right? 15-minute wide range bar. You go, well, it's not extended on the 15, Jared. It's not bad. It's up a couple bars, no big thing. And initially you go, yeah, you're right. And then the void has room to like 885, give or take. Okay, right? And then you look at this and you're like, wait. 1, 2, 3, 4, 5, 6, 7 bars up. Right? The problem is Tesla might actually work. Why? Because stocks don't care. They just keep going higher in this environment. As long as the Fed keeps putting money into the market, irrational exuberance will be what rules the day, I guess. Most of you only know markets that go up in perpetuity. And I know many people who took this yesterday. And this is a flip of the coin. This is a tough one. This is a trade that you could argue to take it, and you could argue not to take it. It's up a lot on the 60, but it was a decent 3-bar play on the 15. But you'll note what happened. Look how choppy it got. This stock struggled yesterday to go higher. This first bar is over $20 wide. Wow, that is a wide range bar, but that's a lot even for Tesla. You can see the last couple days, Tesla's averaging about $40 or $50 in range, and yesterday it struggled. Okay? So again, this is the challenge in trading at times. You will be questioned, meaning you will have decisions to be made. There are times where something is clearly obvious. All right? There are times when something is clearly obvious. And there are other times where you got to really think about it. Okay? Really, really think about it. Okay? So, now, I'm bringing this one up for a reason. All right? Let's start with the daily here. CRMD. Let's start with the daily. Okay? I think most of us would agree. If we gap up over a topping tail, over a lengthy consolidation, and a prior pivot, that's a good gap. I don't think there's a lot of argument here. I think this is a really, really nice gap. Okay? Plenty of void above. Stock's been sitting around the 9 to 950 range for a while. You get a gap just enough to break over that area. So we're starting from a good position. The good position is a high quality gap over a topping tail and a pivot. Great. Our job, drill down, look for a pattern, look for an entry. Well, what's the best play on this chart? You have hindsight information here. I'm showing you all the areas that might be areas you could buy this stock. So gap up, pull back. What's that? About a 50% retracement. Take the high, take the pivot low here, 50%. Well, for me, I think that's a great entry. Just under the 950 area, 940 with a stop at like 920, 930, something like that. And what happened? Rip. I mean, I think that's a rip, like a serious rip. I mean, you're getting a $1.50 move on a 15-cent stop. That's 10 to 1 on your money in 20 minutes. Great. Would I buy that? Maybe on a 1 minute, maybe, but it looks like it happened very quick. So it's possible I would buy the retest here, but that was tough. So now up here, is this a 3-bar play right here? 1, 2, 3 bars up. Is that a wide range igniting bar right there? Well, I don't think so. I don't know what you guys think about it, but I don't think that that's a wide range igniting bar. I think it looks like a wide range ending bar. You're up 3 bars. And that's also after there's one little red bar in there with a bottoming tail, and you're really up 1, 2, 3, 4, 5, 6, 7, 8 bars. So no, I wouldn't take this. Pulls back, goes higher. Okay? Now, wide bar, narrow bar, rip. Guys, wide range igniting bar right here on this one. What do you guys think? Right here. Yes or no? Right here. Wide range igniting bar? Right around this $11, $50, $12 area? Except for David, it's unanimously no. David's on an island right now. Okay? Guys, you're up 1, 2, 3, 4, 5, 6, 7 bars on volume. The volume spike after a 7-bar move generally equals a pullback. Right? Extended with a volume spike usually equals a pullback. Now, what I'm about to show you is the reality of the business. We're walking through this with no emotions because we're not in it. We don't have money invested in it. This is the reality of the business. This is somebody in the chat room. 3R on CRMD, 1196 by 1173, right there. Sold at 1275. CRMD is textbook right now. I took their name out. This happened yesterday in the chat room. You can see the timestamps, 115, 116, 117. Okay? Now, this person actually went on to compliment PTS and how great of a course it was and all this other stuff, and I just didn't have the heart to tell them. This was a bad trade. I know they were riding high on their 3R gain, and I just didn't have the heart to tell them That's a terrible trade. I mean, a really bad trade. Okay? Well, the stock not only had moved from $9.25 to $12. Hello. It was up 7, 8, 9 bars in a row on the 5-minute chart when this thing triggered. Big time volume spike, and they got lucky. It happens. We all get lucky and unlucky. I got triggered in by 1 penny today on SPWR, and then what happened? It bounced. Went the other way. Oh well. Oh well. So they got lucky. But do you see what I'm saying? This person took professional trading strategies and has misinterpreted it. This is not a 3-bar play. And it's not me that was wrong in saying it. What I'm saying is the first 2 lines of the 3-bar play are a wide range igniting bar of a non-extended move, which means it must be the first or second bar of a non-extended move. Well, $9.25 to $12 is pretty damn extended, and 7 bars up on the 5 after that move is really, really extended. Interesting. What's the point? What's the lesson? People misinterpret things. Okay? This is not a 3-bar play in any way that I've ever taught it. But this person thought so, and they thought it was, quote, textbook. It's going to bite them in the big picture unless they learn from it. Recognize the mistake. Okay, now, this is another one. SLS. This is a stock that was just chilling, hanging out, right around 625, rips to 660, 675, consolidates, rips to $7, narrow bar, and rips higher. Ooh, what do we do? What do we do? This is tough, isn't it? You see, guys, you think this is a great 3-bar play because it went from 7 to 870 or whatever it went to. What if right after this, these 2 red bars came in? What would be your excuses? What would be your excuses? If right after this triggered, 2 wide range red bars came in down to $6, what would be the first thing you all say? Look at the ATR. Look at the average trading range. That's the first thing you would say. You go, well, it did go from $6.25 to $7.25. A $1 move on a $6 stock is a massive move. It's probably 4 times its ATR, right? It's the first thing you would say. So does that make this a bad or a good 3-bar play? And this is where trading becomes tough. You see, blackjack, it's just numbers. Numbers. Okay? Trading, we're looking at charts, so there's subjectivity to those charts. How I view it versus how you view it. But math is just math. Okay? So for me, I would not take this because of the average trading range. But I can understand in this market environment that low-price stocks do crazy things. But 4 times, 3 or 4 times your average trading range is a pretty significant move to want to take the high of the day on. I agree it's a wide range bar and a narrow range bar. But that 1 bar right there likely did a full day's range. And it worked. So for me, I wouldn't take it. My rules won't allow me. But I could see how some people might in their plan. But here's the difference. Are you doing it that way every time? That is the question. The consistency. I tell you guys this all the time. I don't really care necessarily what traders do as long as they do it the same every time. They have good money management the same every time. They take the same type of pattern the same every time, and they don't deviate from it. Because if you have good money management, you'll never be broke in this business. I'll repeat that. If you have good money management, you'll never be broke in this business. But most people don't. They risk too much too soon, and they don't know their ass from a hole in the wall. Okay? So, now what? We have a nice gap down on MITK. Pivot, bounced, pivot, up, didn't bounce, gapped underneath the pivot. Plenty, copious amounts of room to go lower. Now what? So that's the gap. That's the wide range bar followed by like 4 narrow range bars. Okay. Last one everyone seemed cool with. Yeah, I'd take that 3-bar play. Now this one's like a 5 or 6-bar play. What do you think? For me, it's tough. It's tough. Why? It's a $15 stock that just moved 70 cents. And we can see here, there are some days where the stock does bigger range than this. There are, right here, and right here, and right here, and right here. There's 5, 6, 7, 8 days, but there's a ton of days it doesn't, and a ton of days it doesn't. You're left with a conundrum here. For me, the ATR is too extended. I know, because I looked at it yesterday and chose not to take it. Now, good news, it didn't matter because it never triggered, right? It never triggered. It actually ended up going higher, all right? So the gap in and of itself is beautiful, but we would have preferred this to have happened around 1550 or maybe 1525. Then I would have said, hey, that's not bad. Okay? So average trading range does matter when you trade. If a stock is already at or has grossly exceeded its ATR, be careful. We're taking high of the day and low of the day trades here. So you better be sure that there's still some steam left in the gas tank. Okay? Or electric left to the batteries, or however they say it these days. Okay? Now, do 3-bar plays work? Yeah. But one of the other things we haven't talked about, and gosh, this lecture could be 5 hours if I wanted to be. What's your expectation? And I'm not going to get off on a huge tangent on this, but sometimes we can take a trade that's a little bit extended if the expectation is to get in and get out quick, where maybe we're not shooting for 3-1 or 4-1. And Unwall talks about this frequently. It's like, guys, I do 3R targets, but if I were doing a 1R target, I'd take this trade right now. But I don't think it's got 3-1, but I think it's got 1-1 in it. See where I'm going with this? So you might be able to take this trade if your target's like 30 cents. You might 20 cents. You're like, all right, I'm going to get a quick scalp out of this thing. But if you're expecting a big move, 3-1, 4-1, this isn't it. This is not it. Okay? So, a good example. Tesla, a couple days ago. Gap up, wide bar, narrow bar, rip. The expectation was to get in and out and move on. It went roughly 2-1, and we moved on. And you can see why. Why? Because the daily chart had some resistance up there to the left. So this was an example where we took an early aggressive 3-bar play, a wide bar, narrow bar, gapping over a prior pivot. And notice, why is the stop loss at the low of the day? Why is that, guys? Tell me, why is my stop loss at the low of the day? Why is it not under bar number 2? Why not? I mean, I teach you guys a 3-bar play. Put your stop under bar 2. Yeah, it's way too whippy and way too spready at that time of the day. We're talking 3 minutes into the day here. You know what kind of spread Tesla has at that time of the day? Do you know how whippy Tesla is at that time of the day, guys? It's super, super whippy. It's super spready. So having like a $4, $3 stop loss on Tesla with a $1 spread and super whippy is not it. So we used the wider stop. And in this case, the wider stop was somewhere around, I think it was it $6 or $7, guys? Something like that. I think it was 814 by 808, I think was the trade, 814 by 808. So I used the wider stop because of the spread and the whip, because I know that time of the day can be a dangerous time to trade. Okay? So the expectation was try to get at least 1R so we can go to break even quickly, and then maybe 2R. And I felt we had that, and it barely did that. May have just missed for some people depending on your fill. Here's another example. This goes to expectation. Gap up. Where's the gap? Take a look at the 60. Let's start on the higher time frame. Gap up, we take out this prior topping tail, this prior pivot, right? Right there and there. What's the expectation? Well, this is what I call a range trade. I know for sure, right? Pivot, bounce, pivot, bounce, pivot, bounce, pivot, bounce, pivot, bounce. You know that it's holding 126 really, really well, but you also know that it's getting slapped at 132. So this is what I call a range trade. If you're going to trade Apple, you're going to trade it from 126 to 132, right? That's what you're going to do. So we see the gap up. You're like, okay, I have void from this pink line here up to this pink line here, which is like 129-ish up to 132. I got about $3, okay? $3. Gap up, wide range bar, narrow range bar, rip. Now, we talked about expectation a second ago. This is a nice 3-bar play. There's nothing wrong with it, okay? You better not be expecting 5-1 on this, though, 10-1 on this, because 132 is just way too big of a resistance point. Pivot here, pivot here, pivot here. Okay? Look at that. Big time pivots. So if your expectation needs Apple to go to 134 to work, well, you can't take Apple. But if your expectation, if you can get to your target per your trading plan before it gets to 132, then it's worth taking this trade. It's a wide bar with a narrow bar. It's in a range. We know it's held support, and we know it has room to 132. So in this case, you're in right around like 129.40. Your stop loss is right around 129, 128. It's about a 50-cent stop. Well, that gives us roughly $2.50. That's a lot of room. That's like 5-1, give or take. So for most traders, this is good enough to take. But if you're shooting for a big target, you're not going to be able to take Apple. Your expectation won't let you. This is where the consistency comes in. And no, this is not a random pop. No edge here. You know, I see some of these, some guy has a high-frequency trading channel, says day traders are just random. No, these patterns work over and over and over and over again. And over and over and over. And then next question, right? How often do I really need them to work? 30, 40, 50% of the time? That's not that much. Shoot, if you had a 40% batting average with 2-1 or 3-1, you're making money. So they don't have to work that much anyway. And yet, most good traders are going to have a 50 to 70% batting average because they've taken out the randomness, because they won't take a stock that's up 9 days in a row. They know what their plan is, and they're consistent in it, okay? There are good patterns, and there are bad patterns. There are patterns that work more frequently than others, okay? Same here. Double bottom retest. No, it's not a 3-bar play. I put it in on purpose because we're talking about random pops. It bounced and pulled back 1, 2, 3, 4, 5 bars down into support. Bottoming tail, volume spike. That's not a random pop. That's what's supposed to happen. When you're extended into an area of support, an area where buyers previously stepped up, buyers will likely step up again. And this is what we mean by past price action predicting future price movement. I mean, guys, the market can be irrational for sure, but the flow of money is the flow of money. You can't deny the flow of money. This is the flow. If they bought it there before, they'll likely buy it back up there again. Not always, though. But that's why you have a stop loss with money management. I've said this many, many times before. I would much, much, much rather train a trader who has great money management and who's terrible at stock picking than vice versa. It's much harder to teach somebody who's terrible at money management and great at stock picking. Money management and trade management are far harder to overcome than teaching somebody a chart. My 7-year-old daughter can learn charts. But teaching somebody the value of money management and the value of trade management, that's number one. Always will be. Okay? You could throw darts at the Wall Street Journal if you're a great money manager and great trade manager. Okay? Really, you might only break even doing so, but you could literally throw darts at the Wall Street Journal. Trading gives us that small edge we need. Technical analysis gives us that small edge we need. And the edge doesn't have to be that huge. Okay? This is the same stock. Day later. So wait, hold on a second. It's just random, right? Double bottom, bounce. That's weird. Oh. That's really strange. The previous day, it did the same thing. You mean it had a double bottom at support and it bounced the previous day, the same stock? That's just dumb luck randomness, isn't it? So what it did on February 2nd, it also did on February 1st. Just randomness though, right? No. There's a method to the madness. especially if you're consistent with your approach and you have good money management and trade management. And that's where most people falter. They're inconsistent and they have poor money management and poor trade management. Okay? You ever wonder why the same traders always win? Why the same poker players always succeed? Because they're consistent with their approach. They're very good at what they do. So, to end this, a couple slides left. A lot of talk about the importance of technical charts, which we just went over, as well as money management or trade management. But if you don't take care of your money, just forget about it. Just quit now. Okay? You'll be on Wall Street Bets, or you'll be featured in one of my dubious segments of When Will the Insanity Stop? If you're unable to manage your account and keep your losing days reasonable, you will never be around long enough to enjoy the freedom and flexibility and rewards this business has to offer. I made the comment in the pre-market today. It's a rhetorical question. Just think about it. How many of you trade well for 4 out of 5 days, but the 5th day takes all your gains from the first 4 days? How many of you trade well for 3 or 4 weeks and 1 week takes out those other 3 weeks? Or 3 days take out those other 3 weeks? A lot of yous. Too many of yous. That's how you know you're inconsistent and you're not managing your money properly. It happens to a lot of traders, and they just sit there and they're like, I'm so close, I'm so close, I'm so close. If I could just ... If I could just eliminate the big down days. Well, stop going on tilt when things aren't in your favor. Today, the market's brutally tough, right? Brutally tough. I'm going to lose a little bit of money today. ABBV is going to get some of that back. But I didn't get hammered. It's only going to be less than a 1R loss today. Less than. Oh, that's easy. That's nothing. But if you lost 5R today, 6R, 7R today, because you kept pressing the button and didn't know when to stop because you thought, I can't possibly lose another one. I've already lost 5 in a row. I can't lose 6. No, you can. And it absolutely happens. Follow your plan. If your plan says 3R and you stop, then you stop at 3. You don't go to 4 or 5. If your plan says you don't take more than 5 trades a day, then you don't take more than 5 trades a day. If your plan says your risk per trade is $100, you don't risk $200. It's really simple. It's not easy. It's just very, very simple. And it goes back to the blackjack analogy. If your system says you bet $5 a hand, you don't bet $25 on this one hand because you just think, oh, I got it. My first card's a 10. I'm going to bet $25. Nope. The plan says 5. Why bet 25? The odds are in your favor. Why are you giving the odds back to the house? Because if you weren't going to break your plan, you wouldn't have a problem agreeing to those terms. Those terms are $100 to Planned Parenthood every time you break your plan. Well, I ain't going to break my plan. Well, then you don't have to worry about it, do you? We ultimately agreed to it. These are the types of things that you need to do. Make it so severe that you will never, ever, ever think about breaking your trading plan. Most of you will never get to that point. You'll never put something severe enough in your trading plan or have somebody hold you accountable to where it's real. You'll just keep telling yourself and lying to yourself. Oh, I'll change next week. No, I'm getting there. No, you're not. You're doing the same damn thing you did a year ago, making the same freaking mistakes you did then. You're not going to change. You're going to quit. Or you're going to blow up your money and then quit. Hey, that's cool. That's up to you. You want to know why the 1%'s the 1%? Because they're the 1%. Sure, there's some luck involved, but they're doing things better than you're doing them. Okay? They are. Just plain and simple. They're doing it better. And guys, don't tell me it can't be done. I don't want to hear it. I don't want to hear it. Okay? Unwell made $9,150 today. He's up another $21,000 unrealized. Wow. 65 grand last month. He's already up 30 in 3 days in February. Don't tell me it can't be done. How do you think he got that account? Do you think he just woke up one day and had $484,000 in his account? Just magically somebody said, hey, Unwell seems to be a nice chap. Good old fella. We'll just drop $500,000 into his account. No, it's not how it happened. Okay? So don't tell me it can't be done. I don't want to hear it. If you want excuses, go find losers to talk to. Go circle jerk each other somewhere else. Misery loves company. Everybody loves to complain, okay? You know what the beauty of the market is, guys? The meritocracy of it. Sure, Wall Street's got an edge on us. Of course they do. But between you and me and the wall, I don't care if your name's Tom Gavin or Josh Barker or Joel Toney or Tina Wolf or Jared Wesley. Guess what? We have the same shot at making it in trading as anybody else on the planet does. We do. The market just is. It doesn't care what your past experience is. It doesn't care what your education level is, your religious affiliation, the color of your skin. It doesn't even care if you have a nice computer or a crappy computer. Market don't care. Why? Because it just doesn't even know who you are. So don't make excuses. If you don't make it, you didn't make it. If you make it, then you made it. That's it. End of discussion. Don't blame anybody else for your failure in this business or your success. Take credit when you do well and accept responsibility when you don't. It's that simple. And guess what? That's a good lesson in life in general, not just in trading. Okay? That's a good lesson in life in general. All right. That's going to do it for this week's lecture. I am Jared Wesley. We'll get back at it again next week.